When you deposit your paycheck, you likely view the bank as a secure vault, a trusted financial partner, keeping your money safe until you need it. But in 2023, JP Morgan Chase reported $49.5 billion in net income. A corporation doesn't generate billions by passively storing cash in a basement. They hit those numbers by aggressively moving and leveraging every dollar that sits on their balance sheet. The moment your deposit clears, the bank reclassifies that cash from your asset into their working capital, an inventory they are now incentivized to use for their own benefit. Modern retail banking operates like a high-volume factory, using your deposits as the free raw material required to manufacture their corporate profits. This factory runs on a specific mechanism called the net interest margin. It represents the gap between the small interest rate a bank pays you to hold your money and the much higher rate they charge to lend that same money to someone else. To see this in practice, imagine a $10,000 deposit in a traditional savings account. At a 0.5% return, the bank pays you exactly $50 after a full year. While you wait for that $50, the bank takes your $10,000 and lends it out as credit card debt, often charging the borrower an interest rate of nearly 28%. This creates a massive imbalance. The bank pays roughly 5.25% to borrow from the government, yet they charge you 28% on a credit card, while paying you only 0.5% on your savings. That 22 percentage point spread between their borrowing costs and their lending rates is where those billions in profit are made. But there is a second invisible factor that actually turns your 0.5% gain into a loss: the annual inflation rate, which averaged 3.4% in 2023. On a $20,000 deposit, the bank pays you $92 in interest. However, a 3.4% inflation rate erases $680 of your purchasing power. In real terms, you are losing hundreds of dollars in wealth every year just by leaving it in that account. In this system, the depositor carries the full burden of inflation risk, while the bank captures the full upside of the lending profit. Beyond the interest spread, banks utilize a secondary profit engine that focuses on extracting capital through manufactured penalties. The overdraft fee is the most common example. If you spend $5 more than you have in your account, the bank can choose to decline the transaction for free. Instead, they process it specifically to trigger a predetermined $35 penalty. The scale of this practice is enormous. In 2023, U.S. banks collected $9.1 billion in overdraft fees, largely from accounts that were already struggling to maintain a positive balance. Many traditional accounts also utilize the minimum balance requirement, threatening a $12 monthly maintenance fee unless the user keeps at least $1,500 sitting idle. This forces you to provide the bank with a $1,500 interest-free loan that they use to fuel their 28% lending machine, while you lose the opportunity to grow that money elsewhere. These retail products are designed as a closed loop, draining wealth by capping your interest growth on one side and imposing heavy penalties on the other. A bank is simply a machine designed to optimize for its own shareholders. To protect your wealth, you must change how you interact with that machine. The most immediate change is moving emergency funds to an online high-yield savings account. This shifts your return from 0.5% to roughly 5% interest, while maintaining exactly the same federal protection through the FDIC. For daily spending, moving to an online bank or a local credit union removes the requirement to hold minimum balances, ending the cycle of monthly maintenance fees. You should also log into your account settings today and opt out of overdraft protection. This replaces the risk of a $35 fee with the simple, free outcome of a declined card. There is also a specific rule for long-term savings. Any capital you do not need for the next 5 years should be moved out of the banking system entirely. Directing that money into index funds or ETFs allows you to capture a historical 7 to 10% market growth, rather than letting it sit as fuel for the bank's own lending profits. By dismantling these specific traps and moving your money into more efficient vehicles, you stop being a profit center for a corporation and start taking command of your